Hello, everybody, and welcome to the 2024 State of the Market for Hoteliers. I'd like to thank you all for joining, and thank you for the ILHA for giving us this platform and opportunity. My name is Danny Nugent, and I'm a commercial property and casualty consultant for USI's National Hospitality Practice. I work with my partner, Garrett Klein, and both he and I are proud partners of the ILHA. I'm very excited to deliver the content that we've prepared for all of you today, primarily because of our panelist speakers. They include three veteran hotel industry experts delivering the perspective of both the real estate and insurance services sectors. So they're going to give you a balanced discussion to help you navigate 2024 with confidence, maximize your profits while mitigating your risk. So without further ado, let me go ahead and introduce you to our panelist speakers, starting with Rachael Rothman, CFA, Head of Hotels Research and Data Analytics at CBRE. Rachael, introduce yourself to the audience, please.
Thank you for having me. Super important topic. I'm excited to be here. As you mentioned, I head up the hotels team at CBRE on the research side, and I guess I'm best known for forecasting, corporate strategy, and maybe capital markets activity. Thanks for having me.
You bet, Rachael. And thank you. Zach, mind introducing yourself to the audience? Zach is the Global Head of Hotels Research at JLL. Happy to have Zach.
Thanks so much, Danny, and thanks to IHLA for having me today, and also the fellow panelists. Really excited. My name is Zach Demuth. I'm the Global Head of Hotels Research at JLL Hotels and Hospitality Group, based in New York City. My background, again, is primarily actually in luxury hotels. I worked for Marriott and for Ritz-Carlton for a number of years. At JLL, similar to Rachael said, I lead our research platform for the hotel space. I do it globally. We're primarily focused on capital markets, investor trends, and investor opportunities.
Fantastic, Zach. Thank you so much. Glad to have you. Now let me introduce you to my colleague, Ryan McBride of USI. Ryan is the Senior Vice President and the Southeast Regional Property Leader. Ryan?
Yeah, thanks, Danny, and thank you to the fellow panelists here. Really honored to be part of this discussion. My role here is everybody's favorite person in the room, the insurance guy, right, Danny? Yeah, so my role at our organization, USI, we're one of the largest property and casualty brokers in the country, and I run the Southeast for our property division. I have a team of 10 analytics experts. We focus on underwriting and placement of insurance for our hotel partners and all other folks in the commercial real estate space and abroad. I've got close to 20 years of experience doing complex property programs, ranging from a couple tens of millions to the multi-billions. So this is a really good topic. The insurance market, as everybody knows, has been very challenging the last couple of years. So excited to cover all of these topics and more in today's call. Thanks for having me.
Fantastic. And let's go ahead and get right into it. I want to focus on RevPAR growth. And in order to do that successfully, you have to understand where GDP is going into 2024. Now, Rachael, CBRE is forecasting a GDP percentage growth of 1.6%. And I think just to give the audience a little bit of context on that number, is it's less than the historical average of 2%. It's a little bit less than what we saw in 2023 at 2.5%, but it's not a recession. And in fact, when I asked you the same question in December, CBRE's outlook was 1.2%. So it's actually trending in the right direction. But, most importantly, what does that mean in simple terms, in terms of the outlook on RevPAR growth here for the hotel industry?
I mean, I guess I would say historically, there's been a very strong relationship between GDP growth and hotel demand. We saw that sort of break down a little bit in 2023. And that is because, number one, we were missing a full recovery in the inbound international traveler. But number two, we're seeing some disintermediation of lodging demand broadly from alternative lodging sources, and that can be anything from a cruise line to short-term rentals to glamping. We've also seen market share gains and exceptional strength in Las Vegas, which sort of shifts the market share across the United States a bit. And then again, Americans went overseas in record levels in 2023. So there was this disconnect. As we think about what we're looking for in terms of 2024, the slowdown in GDP, we're expecting it to translate into a slowdown in RevPAR growth, albeit still positive. We're currently in the market at 3%. That's about a 60 basis point increase in occupancy and about 2.5 points in rate, which is somewhat commensurate with inflation. So hopefully that's helpful.
Yeah, that absolutely is helpful. It's right around the rate of inflation. And, Zach, where do you expect to see RevPAR outperformance going into next year? Are there any particular types of hotel asset classes that you're really focused on?
Yeah, I mean, I think just kind of echoing Rachel's sentiments, what we saw kind of early COVID is this boom in leisure luxury travel, right? Americans generally stayed domestically because you couldn't travel abroad for obvious reasons. Consumer savings in many instances was at an all-time high because there was this surplus money kind of working its way through the system. And so leisure markets generally outperformed. First, it was drive to. Then when Americans got comfortable with flying, it was fly to, places like the Florida Keys, like Southern California, Hawaii to some degree. We didn't see a whole lot of urban demand. At first it was because a lot of urban markets, there was this fear of being around people, right? Think back to early COVID when there weren't vaccinations. We didn't know a whole lot about the virus. Urban markets were generally disproportionately negative impacted. Fast forward now, it's, we're 3 and 4 years, but beyond, this early COVID, and cities are seeing this resurgence in demand. Not only are Americans traveling more and more frequently to urban markets, we're seeing this resurgence, again, not back to 2019 levels, but a resurgence of international travel, which primarily impacts gateway urban markets, places like where I live, New York City, the West Coast, Los Angeles, Miami from the South American traveler, and many others. And so, I think as we look to 2024 and even beyond, we'll start to see this, resurgence of urban market performance. Again, it's not going to be even across the board, similarly to how leisure markets were not all, the same. It's still an uneven recovery, but there are going to be some markets, again, pick on New York City because it's where I live. Miami is a great example. I think the West Coast a little bit slower, but we're starting to see it recover. And so I think 2024 is really going to be the year of the urban market from a traveler perspective. And then, I know we'll get into it, but as well from a hotel investment perspective.
That's fantastic. And is there any special amount percent that RevPAR would have to grow to maintain constant EBITDA margins? Are we expecting any EBITDA margin growth in 2024, Rachael?
Okay, so everybody has a different definition of margin. So let's just talk broadly. If you were to say GOP margin, which is before your management fee, before your property tax, and before your insurance, I'm going to say you probably need about 4% RevPAR growth to hold your margins. That now every market is going to vary. We have to keep in mind we've seen significant increases in food costs, in minimum wage, and in wages generally, and those are large categories that can influence the profitability of your hotel. If we look below the line at property taxes and insurance, where you guys are more experts, but we're of course seeing even faster growth in these categories. So if somebody's really referring to NOI or after those charges, I think you'd probably need to be above 4% on average.
Fantastic. Thank you so much, Rachael. Zach, let's focus on interest rates real quickly. So last year, it seems that interest rates have peaked. The Fed had 5.4%, roughly speaking. And I think CBRE is anticipating a 1% interest rate cut going into the second half of 2024, and even further cuts potentially in 2025. So what does that give us to look forward to in transaction activity in 2024?
Yeah, I mean, I'll start by qualifying. I'm not an economist, so I definitely do not forecast interest rates. But I think CBRE's forecast of 1% cuts is pretty in line with the others. I think JLL we're at 1.1%, give or take. But I think regardless of what the number is, we're at the point consensus that it's not a matter of if, but when interest rates will fall. We've been in this period of uncertainty for the past, call it 12 to maybe 18 months, where interest rates were rising at growth rates that we've never seen before. And there really wasn't clarity about when the interest rates would stop rising. If we look back at the last 4 or 5 economic cycles, typically the Fed will increase rates and then they'll start plateauing, and the plateau will take place for about a 9-month period, give or take. Well, we're now at the 6-month mark. So by that math, we should start to see cuts again, maybe the March or April Fed meeting. But again, it's from a transaction perspective, obviously rates going down has a meaningful impact, but it's really about the clarity. It's really challenging to underwrite a deal when you don't know if you're underwriting at 6% interest, 8% interest, 10% interest. As Rachael mentioned, there's ongoing cost pressures. And so if you don't know what your interest rate payments or your debt service payments going to be, it's really challenging to get that deal done. I think that now that we all understand that interest rates have plateaued and are likely going to decline, that'll allow transaction activity to get done, particularly in the hotel space where we're a very interest rate sensitive space. We're an operating business. So unlike offices or industrial or multifamily, our leases essentially get reset every single day. And so by that matter, we are extremely rate sensitive. And so because of that, as interest rates now have plateaued and will decline, we expect that to catalyze transaction activity. The other thing I'll say is that regardless of rates declining necessarily, at least having that certainty, we have a number of loans maturing this year. And the hotel space alone is $80 billion of loans maturing by the end of 2024. Not saying all of that is obviously going to lead to transactions. There's going to be a number of refis or workouts. But when you have interest rates coming to a point and loans maturing, inevitably that's going to cause something to take place. And so our house view at JLL is that will ultimately catalyze an acceleration of transaction activity. We likely won't get back to where we were last year or even the prior year, which were record years for 2021 or 2022, which were record years for hotel liquidity, but we definitely will see a bit of an acceleration.
I think Zach's exactly right. But if I could just add one nuance, we need to make sure that we get the rate cuts without a slowdown in the economy. If the cause of the rate cuts is that GDP is declining or unemployment is increasing, then yes, we'll get the favorable interest rate shield or the improvement possibly in people's financing costs. But if it comes with decelerating top line, that can be a bit of a push-pull. So just one nuance to tack on to what Zach said.
Yeah, that soft landing can certainly be a sweet spot, for our industry. And, even last year, Zach, I think 19% of hotel transactions were from first-time hotel buyers. So not everybody even needs to finance in order to purchase hotels in this marketplace. Do you think we're going to see a lot more of that continue going on into next year?
Yeah, so I mean that 19% was on a global basis, right? So a lot of that came from foreign capital, which is something that we haven't seen. We haven't seen foreign capital buying hotels over the past 3 or 4 years for obvious reasons. There's geopolitical uncertainty, there's border closures, et cetera. Typically foreign capital, so sovereign wealth funds, high net worth individuals, family offices are a lot less interest rate sensitive. They're either all cash buyers or they have their own financing sources that don't rely on the public markets. So I do think we will see a continued surge, particularly when we look at luxury assets, foreign capital, whether it's from the Middle East, select Asian investors or European investors typically gravitate towards what we call must-have assets, which is predominantly luxury. So I do think we'll continue to see a surge there. And generally, hotels have emerged for some institutional investors as more of a favored asset class. Again, in some ways, resetting your rates on a daily basis is quite advantageous because you can, in some senses, hedge against inflation. Again, if you can reset your rate every day, theoretically, you can offset inflation. We all know that practically that isn't always the case, but we have generally seen ADR outpace inflation. And so because of that, we've seen more institutional investors come to the table. I do still think we need the kind of core hotel investors to come back. Not that they've necessarily left, but As we know, liquidity was down significantly last year. And so, yes, it's great to see all this new capital coming to the space, particularly for luxury hotels. But the reality is we still need our core sense of private equity and public REIT investors to come to the table, because that's ultimately what drives the bulk of our total global or even US hotel liquidity.
Yeah, and Ryan, I know that you work with hotel owners to help them understand what the insurance costs are for a particular transaction. Can you talk about that process and how you help them look at specific hotel assets to make decisions while taking into consideration what that cost for insurance actually is?
Yeah, absolutely, Danny. And I think, that's a pretty broad question. A good place to start is how the inflation and interest rates actually impact the property insurance world. To Zach and Rachel's earlier comments, I think everybody that's been in the hotel business, especially in the last 2 years, has had quite a time obtaining, reasonably priced insurance on their assets, especially in the property side. We'll leave casualty for another day because that's an animal all of its own. But on the property side, the last 18 months or so have been what most would call the hardest property market in modern times, probably certainly at least since 9/11. And the one of the two core drivers of that market were record high interest rates, which saw most of the non-traditional, what we call reinsurance capacity. So those are the insurance companies for the insurance companies. The non-traditional capital kind of fled that market because they had losses, and they looked over at a very, very high interest rate and said, hey, I can make more money in a treasury bond than I can in putting it into the property insurance market. So you add to that rampant inflation, which was driving the cost of goods and especially building materials through record highs, labor and everything else accordingly. And you really had a perfect storm where we had severely reduced capacity and exorbitant rates that were being charged. Now, there's a lot of other both micro and macroeconomic factors that are specific to insurance that drive that process, but I'll try to keep this on point for today. I will tell you that the both inflation being down around 4% and interest rates looking to drop is going to spell very good news for anyone purchasing property insurance going into 2024 and beyond, if we maintain that kind of track and we avoid massive amounts of catastrophic loss and underwriting profit losses the way that we had in 2021 and 2022. Hopefully we will see a return to additional investment in the reinsurance space to balance out some of the void that had been left unfilled and basically required reinsurers to drastically increase their own pricing and their own retentions for traditional domestic insurers. So their deductibles, if you will, their ability to cede the risk that they write. So for new buyers or current buyers in the market going forward, I mean, one thing that you can count on is that while the price may come down a little and there may be more interested parties and the rates may be reasonable or more reasonable, we should say, we've had a paradigm shift in underwriting, and we are not going to go back to 2008, 2009, 2010, where there was kind of a run on the insurance market where big companies and large panel capacity driven MGUs were coming in and just buying schedules of business with no limits in sight. That's gone. That's gone the way of the dinosaur. What we will have are aggressive companies looking to properly underwrite a risk and get a profit out of that risk, but do so in a way that doesn't make a client feel extorted, make them feel like they're buying insurance and then they don't have any insurance at all. And that's where we're seeing great success right now. So the way you do that, if you're a hotelier, is make sure that the assets that you're looking to acquire are insurable. Make sure that they are of good risk quality. Pay attention to the area that you're purchasing those assets with respect to crime. Pay attention to the potential for flooding or windstorm type exposures, and make sure that you are budgeting for specific protections that you might want to put in place, or renovations to that property you may want to do to make it more palatable for an underwriter. And the next thing would be to select a broker that's going to understand how to navigate that market, and basically help communicate your story to the underwriters. So a lot of times in the insurance world, we hear saying garbage in, garbage out. So if somebody is taking something that's been done before and just shoveling that out to the market, your same schedule that's been looked at 13 years in a row by the same people and never gotten any data they needed, you're not going to have a great result. You really need to get very serious about the amount of data that you're collecting on your properties, and making sure that your values and everything else kind of fall in line with what an underwriter wants. And then you have to be cognizant about your own tolerance for risk. So if you're willing to take on a little risk, you're probably going to do very well. If you're not, or unable to due to lenders, then you need to get creative, and you need to have people that have a good understanding and grasp on how to manipulate the insurance placement process in such a way that you are able to, continue to get cash flowing assets despite high costs.
So just to circle back, with that, Ryan, last year was a really challenging year from a rate perspective. Are we not anticipating as many challenges looking ahead into 2024 for commercial property renewals? How are the rates looking? Are they going to stabilize a little bit?
Yeah, Danny. So, our own market outlook has some varying information depending on what kind of asset you have, and where it is located, and what your risk picture looks like. So, we gave a reasonable forecast on what we would call non-cat exposed assets. So that's going to be something that is not really exposed to hurricanes or earthquakes or massive wildfire potential, something that's maybe a bit inland and more traditional. Those, may have a pretty reasonable go of things in 2024. However, they're likely going to see some terms restrictions, especially in the convective storm exposed areas. So the Rust Belt, people with tornado exposure, this past 2023 was a record year for those types of losses. So those types of programs you may have some trouble with, but tremendous rate increases, probably more in the 10 to 15% range, maybe a little bit less depending on your risk quality. On the cat exposed side, the challenge really is, what's your data quality, your risk quality, your loss experience, and your appetite for taking on risk. So, hotels as an asset traditionally for property, very high BI exposure. If we have an asset that's gets shut down, especially during peak season, that can cost a carrier a lot of money. So what we are looking at right now is an insurance world where over 2023, a lot of the terms were restricted, and a lot of the deductibles were increased. So a lot of the carriers feel a bit more isolated from that initial loss than they might have felt last year with those new terms. But that doesn't mean that they are just going to throw the underwriting rule book out. So I do believe that we'll have some stabilization. We were already seeing that, here, 20, 35 days into the year. But if you are placing a 1980s joisted masonry 4-story hotel, on Miami Beach, it's still not going to be an easy insurance placement for you. So getting that data and those updates and being mindful of those challenges will be key. Like I said, making sure that you are taking the appropriate approach to that process, and we can kind of cover that a little bit more later.
Fantastic. Thanks a lot, Ryan. Appreciate that. Looks like things are getting a little bit better compared to
last year. Little bit. Yeah, certainly better than last year. I'm not telling anybody that they can expect flat renewals, but I think if anybody's being told, that they're looking at 40 to 60 to 100% increases this year and they already went through that last year, then there's probably something wrong with that placement.
Perfect. And I want to talk about, Rachael, with you, global travel trends, because there still seems to be a lot of opportunity on the table, especially when you compare global travel trends to the pre-COVID era from specific countries outside the United States, in terms of how frequently those people are coming into the United States and staying at our hotels. What can you tell us about the difference in global inbound and outbound travel trends that you're seeing in the marketplace?
Well, as of December, Europe and the Caribbean inbound to the US had almost made a full recovery. The markets that were missing the most are, of course, China and Japan. Japan really influencing the Hawaiian market. So I think it's a question of both their economic wherewithal to travel. It's the rates that the hotels are charging, right? We've raised rates quite a bit. Foreign currency can influence people's willingness to go abroad in both directions. Visa restrictions, adding back long haul flights. Our personal view is that it will take between 2024 and all of 2025 to see a full recovery in the inbound international Asian traveler. Could there be some upside to that? Yeah, absolutely. But we do believe that the sort of economic slowdown that you see in some of those regions could be a headwind to a quick snapback in demand.
Yeah, no, perfect. I read that, China inbound travel into the United States is only at 50% of the level that it was pre-COVID. So certainly you hope for a little bit more room for growth in that regard. Zach, tell me about, global travel trends. If you look over the past year, right, the strength of the US dollar incentivized a lot of US foreign travel, particularly in areas such as Europe, where they can stretch their dollar that much further. What are you seeing with global travel trends going into next year?
Yeah, I mean, I think as it relates to inbound travel, I totally agree with what Rachael was saying. As it relates to outbound, and Americans traveling, I think, yes, the strength of the dollar helps. I also think we have to look at consumer savings. We all talk about consumer savings as it relates to domestic spend, but the reality is that it also aids in American spending abroad. And coming out of COVID early to mid 2021, US personal consumer savings was at an all-time high or close to it, depending on your source of data, roughly around $4 trillion in US bank accounts. Again, interest rates were basically zero, so money was free. Inflation hadn't yet started creeping up, and then there was all of this stimulus money circumventing the system. So Americans generally were flush with cash. And that actually, as travel started reopening, yes, it definitely helped domestically, but it also really fed a lot of Americans traveling abroad. To Rachel's point, we've seen a near recovery of European travel inbound to the US. We've also seen a near recovery of American travel outbound to Europe. Again, it's predominantly Western Europe for somewhat obvious reasons. Places like London, Paris, Rome are seeing record high RevPAR levels. I think as we start to see consumer savings contract, which has already happened, again, driven by rising inflation, or I guess inflation's falling now, but it was at the time rising, interest rates, again, that not only impacts commercial interest, but also US Americans, right? You look at car payments, you look at credit card payments, right? That has a direct impact. And then we have to keep in mind that student loan repayments were reinstituted, which has a material impact on consumer savings across majority of Americans. That will ultimately influence Americans traveling abroad. And so I think we'll see less Americans travel abroad next year, which will benefit our domestic hotels. Not to say there won't be any about abroad travel, but I think it will be limited. The one thing we have to keep in mind is that there's a major world event next year, that being the Paris Olympics. The first, there was an Olympics, of course, in early COVID, but I don't think that counts as much from a travel perspective. And historically, the Olympics is obviously a major world event. And I think our belief is it's going to drive significant international travel, both intra-regional travel in Europe, Americans traveling to Europe, the Asian traveler, maybe less so in China, but heavily skewed to Japan, Korea, Australia, New Zealand. So I think from a global perspective, our house view is that globally international travel will recover next year. But it's really going to be driven by international travel into Europe as opposed to international travel, into the US or into other regions.
Fantastic. Yeah, a lot of people are going to be traveling to Paris and even the UK. And, one day, hopefully, we'll get more inbound travel from overseas in certain areas because that will certainly help out. Ryan, so just kind of closing out this discussion, what are three areas that hotel owners should focus on to be successful from an insurance perspective in 2024 and beyond?
Yeah. So it's a good way to recap, because I know we've given a lot of data here, and I'm sure Zach and Rachel have their own comments from their areas of expertise. From an insurance perspective, especially on the property side of the aisle, but also across all sides, really making sure that you're differentiating yourself from a risk quality perspective, making sure that any amount of data that you're either providing to the market through a broker or other intermediary is really grounded and demonstrable, making sure that you're choosing the correct insurance broker for that process, I think is probably the number one most important thing that you can do. Like I said before, there's a lot of nuance to placement, insurance placement, not just negotiating, but making sure that the story is being told properly from a data standpoint. And in years past, this was less of an issue. The insurance was in not as much of a demand, and realistically, there was lots of capacity. Now it's still the other way around. So you really need to differentiate your asset and your risk. The way that you're going to be able to do that is by having somebody in the market that is having conversations with underwriters on an underwriter level, somebody that really understands that conversation and can kind of help make the best case for you. In terms of just pricing in general, like I mentioned before, making sure that you are looking at all aspects of taking on risk, whether or not that's taking on a larger deductible, if possible, or perhaps combining some of your properties or your assets into a single, what we call master program, where you can share those limits among the many for the benefit of all. Carry less of them, have to purchase less amount of capacity from the market. And then also, seeking to rebuild underwriting relationships abroad. The last 5 years or so, we had not seen much activity across the pond from the London market. And that market is back in the end of 2023 and into 2024 in record amounts of capacity. The pricing's where it needs to be for them, and they offer significantly more compelling terms and some good pricing for what they're bringing to the harder to place risks, I would say. The final thing is making sure that you are diligent about your loss history and your loss record. So making sure that you've got your employees and your personnel looking out for potential claim events and making sure you have the right procedures in place to make your particular risk of the best possible quality. Shock losses occur, but that doesn't mean attritional losses need to be the name of the day. So if there's a way to put together a mitigation program for potential water damage in your hotel to differentiate yourself with sensors or other procedures, if there's a process that you have in place for ensuring, no smoking from employees, et cetera, things that are just going to cause little claims, little death by 1,000 cuts, if you will. Those are going to go a long way. And then making sure that you invest properly, as I mentioned before, both in secondary protection, but also in making your properties really stand apart from every other property.
Perfect. Thanks so much, Ryan. Appreciate you. Starting with Rachel and then to Zach, can you each please give me 1, 2, or 3 big things for hoteliers to capitalize on in 2024 and beyond?
I guess we'd be really bullish on sort of boutique or luxury, ultra luxury properties where demand would be tied to wealth creation with the record S&P that we're seeing. So not mass market luxury, but true smaller trophy assets in fairly isolated destinations where the 1%ers go. In terms of broad market, we'd be most bullish in the US on assets that have a leisure component or where you can house a group event and people can stay for leisure. That would be markets like San Diego, where people might go and stay a few extra days after their conference or convention. Las Vegas really built on that model as well, right? That market is doing tremendously well with all the sports teams. So I think that's a theme that you can count on. And then I think we should expect to see more brand partnerships across consumer companies, everything from retail to multifamily housing to hotels, just sort of converging together to drive customer acquisition and to reduce those costs and increase brand awareness. And if I had to give you something final, it would be try to find a premium experience where you can charge a lot of money and where your labor costs are still relatively low. And we see a lot of success with that recently in Central and South America, where they are able to drive sort of record high rates, and yet labor maybe doesn't flex the same way as it does in some other markets.
Perfect. Thank you very much, Rachel. Zach, what about you?
Yeah, I mean, I think if we look at it from an investment lens, a lot of what Rachel and Ryan said definitely holds true. I think the big thing for us is looking at this general contraction in new hotel development, and what does that mean from an investment perspective about buying new hotels. So I think the big thing is looking at what we call discount to replacement, essentially. How much less does it cost to acquire a new hotel than it would be to build, or acquire an existing hotel than it would be to build a new one? And with construction costs, generally rising or at relative all-time highs due to supply chain disruptions, high labor costs, materials, everything that Ryan mentioned, not to mention it's been challenging to get construction financing. We see a really unique opportunity for well-capitalized hotel investors to acquire quality assets at relatively high discounts to replacement. And this really, the second big trend, and this lends itself to that, is this opportunity in urban markets where discount to replacement is often higher. You look at major urban cores, again, like New York, like Los Angeles, like Chicago, it's even more expensive in those markets to build new hotels. In some cases, nearly impossible because of new zoning laws. And so the opportunity to acquire an existing asset, even if it requires some sort of capital expenditure, is really a unique and potential historic opportunity for investors. And then this lends itself to the third area, which we'd say is similar to what Rachel said, is must-have luxury assets, often irreplaceable assets, whether it's because the cost of new construction is exorbitant, whether it's because they're in locations that you are unable to physically to build a new hotel, either because of lack of labor or zoning or whatever the case may be, or it's because they've created an experience that cannot be replicated. And we see more and more investors gravitating to this area. Obviously, there's high consumer demand, evidenced by growing wealth. The 1%ers continue to grow, whether it's here in the US or internationally. And so we see a real trend towards this, and we see a real opportunity, whether it's here in the US, internationally, in parts of Europe and Asia, for investors to acquire must-have luxury assets at potentially, a pretty significant discount to replacement.
Hey,
That's
Danny, if I
fantastic.
can add one more thing to Zach there, because he hit the nail on the head. New builds from an insurance perspective are still very hard. The builder's risk market is very challenging, especially due to the frequent losses they suffer, and especially if it's anything having to do with combustible construction. We just had a $68 million fire on a big luxury apartment up in Jacksonville, Florida, about 2 weeks ago. So that builder's risk itself is really challenging, and there's always delays in those projects that can really cut into any potential cash flow that you might be having come your way. So I would echo Zach's comment regarding, seeing investment in existing buildings, which are then retrofitted and updated. That's definitely an area of focus that I see a lot of our clients doing as well. So it's definitely a big spot.
Yeah, and despite any perceived challenges, there's always opportunity for improvement and outperformance. And so with that being said, I just wanted to say thank you again to our speakers, Rachael, Zach, and Ryan. All three of you did a wonderful job. I will highlight to our audience today, if anybody would like to dive deeper on their specific needs or issues, we welcome a one-on-one consultation so we could talk about that with you further. And with that being said, we hope that you have a great rest of your week. Thank you very much for your time. We look forward to connecting with you soon. Take care.